Good morning. Welcome to Power 30. It's September 21st. We have an awesome economist on today. But first, the news. Largest modular project in Twin Cities history, challenging the eviction moratorium, and the economy. Just how screwed are we? I'm Todd Phillips, your host. Power 30 starts now. According to Globe Street, the National Apartment Association has joined the New Civil Liberties Alliance in a lawsuit challenging the CDC national eviction moratorium that it ordered earlier this month. There's a 2-week waiting period after filing, but the hope is to get a hearing as soon as October on the matter. The lawsuit claims the CDC's actions are not authorized by statute or regulation, and I quote, "But even if they were, they are unprecedented in our history, and they are an affront to core constitutional limits on federal power. If allowed, the order would," love this part by the way, "abrogate the right to access to the courts, violate limits on the supremacy clause, implicate the non-delegation doctrine, and introduce anti-commandeering principles." We seem to be revisiting the Founding Fathers quite a bit these days, folks. It's time to bone up on your knowledge of the Federalist Papers. The National Multifamily Housing Council, NMHC's easy for you to say rent payment tracker found that 86.2% of apartment households made a full or partial rent payment by September 13th in a survey of its 11.4 million units of professionally managed apartment units across the country. This is a 2.4% decrease from last month and compares to an 86.9% last year. That's a total of 279,457 folks who haven't paid their rent. Congress' continued failure to pass a stimulus package and states reportedly running out of money for the increased unemployment amounts, well, as we are all collectively holding our breath for Congress to act, or this will certainly get worse. According to an article by Dan Rafter of RE Journals, Ackerberg and Northland Real Estate Group are set to develop the largest modular construction project ever tackled in the Twin Cities metropolitan market. Ackerberg is set to add to the multifamily housing stock in downtown St. Paul. In doing so, Ackerberg will bring the largest modular construction project ever built in Minnesota. And the best news of all, this project is happening in the middle of the COVID-19 pandemic. More evidence that the commercial real estate market is trying diligently to keep the pandemic from slowing new construction. Rise Modular, the startup manufacturer of commercial modular buildings, produces the component building style out of its 141,300 square foot climate-controlled facility up in Owatonna, Minnesota. Condo deconversions should be dead in Chicago. The voting threshold was raised last year from 75% to 80%. Add to that rock bottom interest rates promotes home ownership, and the pandemic causing many investors to pull back on their reins, yet the deconversion trend persists. This was the message from the panelists during the 3rd annual Deconstructing Deconversion in Virtual Summit. However, the landscape has changed, and there are lots of blind corners that brokers, investors, and associations should be aware of undertaking a deconversion. You can watch this virtual conference in its entirety, the same place you are watching this show, our YouTube channel. According to CNN Business, the U.S. job market remains in a deep hole during the ongoing pandemic, and now the recovery is losing some of its momentum. Employers added 1.4 million jobs in August. It's relatively good, but job growth at that level indicates a slowdown from earlier this summer. Employers added a revised 1.7 million jobs last month and 4.8 million jobs the month before. It seems every person who can go back to work is a win after the unprecedented crisis. However, America is still down 11.5 million jobs since February. Millions of families are still in need of benefits to make ends meet while Congress continues to argue about the next stimulus package. Do you sense a theme here yet? According to MSN Money, consumer spending and consumer sentiment are in conflict, which may have negative implications for GDP in coming months, especially with the holidays approaching, which many retailers rely on to make their year. The University of Michigan has released its preliminary reading on consumer sentiment covering the month of September. The headline sentiment rose from 278.9 from 74.1 a month earlier. This is a sharp rise, but for reference, the pre-pandemic readings a year ago was 93.2. We were at 93.2 last year, 78.9 today. JP Morgan has indicated that consumers who used their Chase credit cards in the past week spent roughly 6.5% less than they did a year ago. This is also slower spending than the week before, with a 3.5% drop was shown. The slower spending would also indicate concerns that the federal economic support has started to fade. With shaking consumer spending, along with a sputtering job market and fading rent collections, what is the economic outlook in coming months? Let's ask JLL Chief Economist and Adjunct Professor at Columbia and NYU, Ryan Severino. We also ask how you can make a chart that looks like a K. Off to Ryan. When I heard this, I sat down and I went, okay. This does not look like a graph.
Right.
And then after thinking about it for like a day, I'm like, now it looks like a graph. Oh, so I think part of it is you just had us all dumbfounded for a while. Like, that doesn't, I understand a V, I understand a U, I understand a bathtub. I understood the Nike swoosh when somebody brought that up, but I couldn't understand the K. So just tell me about the genesis of why you started thinking in this shape and some of the background to it.
It really came from the idea of looking at the data that this was a very uneven economic recovery, even relative to ones that we've seen in the past, which I would concede are even in of themselves tend to be a little bit uneven. But I think one of the things that characterizes this downturn, especially in the context of the conversation that we were just having, is that there is a greater rift between, however you want to characterize it, the have and have-nots of the world, in the sense that there are certain parts of the economy and there's certain households within the economy that, at least from an economic financial point of view, are faring better than they were at the beginning of the year. There are some that they haven't come through this unscathed. They've struggled for a while, but they've largely recovered and might even be back above where they are. And then there are some that are still struggling right now, despite the fact that the economy has, I would say, objectively improved over the last few months by the metrics that we can measure thus far. And then, unfortunately, there are people who are really struggling right now with the food insecurity and the threats of evictions and things like that. So the mental image in my mind wasn't quite literally a K, but it kind of penciled out that way. Some people have shot straight up. If you work for a technology company or you're an investor in a technology company and the world has increasingly relied on those, you have probably made a lot of money during this downturn. If you're in the investor class, you have a white collar, high value add, skilled service sector professional job, you're probably still working from home and you've probably also benefited from the stock market. And then there are the down legs. You have to have a service sector job that can't be done at home, a lot of which have not come back, even though the labor market's been recovering. You are probably still struggling, especially since the last fiscal stimulus package expired in the summer and hasn't been renewed yet. And then, like I said, unfortunately, there is a segment of the population that is still really struggling with job loss and potential eviction. So in my mind, those were very divergent paths for segments of the economy and segments of households within the economy. Whether or not it literally looks like a K, it helped for the visual. But I think as soon as I made the point to people that it wasn't literally a K, but these are clearly divergent paths forward, I think people latched onto that idea and understood it.
Yeah, I agree, including me, and I'm just a hack economist. I think the thing for our listeners to try to figure out is what happens now. And there's a couple paths, I think, and tell me if I'm wrong. Sorry, I just blew up my whole screen. Is if the stimulus, that last round of stimulus is passed, or if it's not, do you believe that has a big impact? And what do the two futures look like?
Absolutely. So one of the key risks that I highlight given where we are, because I think objectively the economy has gotten better. And I think in some respects, it's probably improving faster than I think many people thought. But I think an important underlying factor to that was stimulus on the part of the government, both monetary policy from the Federal Reserve and fiscal stimulus from the federal government. The fact that it has not been in place for the last, say, month and a half or so, I think you're starting to see signs in the data that it is becoming a bit of a headwind to growth. And I think where we go from here will, to a large extent, depend on that. And I'm a pretty laissez-faire free market economist most of the time. I'm not, raging anti-government crusader. I think fiscal stimulus and government spending policy has a role to play. And I think maybe we should be more intelligent about it than we've been over the last 30, 40, 50, 60 years. But when I look at the situation right now, what concerns me is that there's an impairment in the private sector that can't get fixed on its own relative to a normal economic cycle. So what do I mean by that? What I mean by that is there's certain businesses that are either closed or operating at a limited capacity because of government edicts surrounding health concerns. So obviously they're operating at limited revenues, limited staffing, et cetera. And then there are just other activities that consumers are not voluntarily willing to participate in out of fear of getting sick. There's no government edict right now that says you and I can't get on an airplane, but the overwhelming majority of people won't do it right now, or stay in a hotel, but the overwhelming majority of people won't do it right now. So until we get past the pandemic and we don't need to have these strictures in place, or people start to feel more comfortable about doing those things in a safe manner, you're going to have consumer spending impaired by that. Normally, in a downturn, what you would probably see is that prices in the economy would adjust. Businesses that saw their demand decline would start to lower prices, and then people would respond to that, and you'd get a corrective mechanism. Companies would see that inputs to production were lower. They'd start to ramp up production, but they're not doing that now because of the uncertainty surrounding this and businesses staying away. And so I say this a little bit flippantly, but people are doing the math at home right now, and they're not sitting there going, these flights to Hawaii, they're ridiculously cheap. We might die 3 weeks later, but let's go out with a bang. Like nobody or very few people are doing that. Most people are saying, you know what? Hawaii will still be there when the pandemic ends. We don't need to do that. And so until we get past the pandemic, which is an emphatic point that I make, that the pandemic is the recession, that the pandemic and the economy are not independent of each other, then that normal self-corrective mechanism of to sound like your economics professor for a minute, but price elasticity of demand, the idea that you can lower prices and you can get demand to increase, doesn't work if people think that buying that good or service potentially puts their health at risk. And until we get past the pandemic, that will not correct on its own the way that it does during a normal downturn.
Maybe tell us where we're at right now, in your opinion, and then where does it lead us?
So let's do jobs first, and then we can connect that to where I think the market more broadly is going. I think we've done a respectable job of gaining back jobs that were lost. We are still down significantly. We're still dealing with an unemployment rate of about 8.4%, which is, I think, by any normal recession would be looked at abysmally. It's clearly an improvement from the almost 15%, 14.7% that we were at least the technical measurement at the peak. So we have definitely made some progress on that. I think the thing that we're seeing in the data is that the progress is slowing. If you look at not just the number of jobs created on a net basis every month, if you look at the unemployment claims, both the standard claims and continuing claims in aggregate, it's painting a bit of a picture that we're stuck a little bit. And it could even be a little bit ambiguous, because you could have some people falling off of unemployment insurance just because they've exhausted the benefits at this point. I do think we're making progress, and I do think we will continue to make progress. A little bit of that is contingent upon what we were saying about government financing. But I think the labor market, barring the most dire scenario that I can reasonably conceive of, or scenarios I could conceive of, should continue to mount a recovery. I think the rate is slowing down as we pick the low-hanging fruit off the trees to a certain extent, and now it gets harder if businesses are operating at a limited capacity. It's easy to open up a business at 40% capacity and hire 40% of your staff back, but if you can't get to 100% capacity because of restrictions in place, then you can't bring that staffing back online. So we picked the low-hanging fruit off the tree, and I think we're making incremental progress. And I think we will probably continue to do that until we get to, I will roughly say, the middle of next year. Maybe I'm being optimistic about this, but I think at least as far as I can peer into the crystal ball and see what epidemiologists are saying and virologists are saying and all of the people working on these vaccines, that maybe reasonably by the latter half of next year, we can start to see distribution of it. If that's the case, then I think we could start to see an acceleration around then. As far as tethering it back to the marketplace, I think one of the things that you've seen up to this point is that I think there are a lot of people who are probably surprised by the fact, maybe superficially surprised by the fact that values haven't really turned down. And I think there's almost always a lag between when you see impairment in the economy and when it ultimately filters through, I think, into the real estate market. But I think there's been a sense out there on the part of borrowers, on the part of lenders, on the part of landlords dealing with clients, that they thought they were going to get through the worst of it and then we would start to see some improvement, which I think objectively has been true. I think the real question is, now that we're this far into it, can they keep playing that game? Can that persist? And I think there is distress out there. If you pay attention to what's going on in like the CMBS market showing signs of underlying distress, the real question is, does that start to manifest itself in terms of sales and impact on pricing? And my guess would be that yes, it does. That you're going to almost certainly see some pressure on cap rates and pressure on valuations, pressure on certain sales that people will almost maybe not quite as daunting as some of the ones that we saw during the financial crisis, since that was obviously very well rooted in the financial markets, that downturn. But I would not be surprised to see more of that coming as we go through this, because I think the longer this goes on and the more durable it seems like some of this impairment is, then it's going to be harder to play that game of, well, let's just not do anything, wait a few months and see. I think you've seen lease modifications. I think to an extent you're probably starting to see some loan modifications. They're going to play that game as well as they can. But I do think ultimately it will filter through to the marketplace. I think there has just been a lot of wrangling that's been going on to try to keep that from happening. I think there were some good lessons learned during the last downturn of maybe moving too quickly and ruthlessly into a severely imperiled market. I think they're trying to avoid that to the extent that they can. But I think it's really improbable to think that everybody is going to come through this without suffering any ill effects from it. I don't think it's probably going to be as daunting as the previous downturn, because I think we learned some lessons about that in terms of reliance on debt and leverage and getting extended over our skis, and you're not seeing that this cycle. But I do think the demand impairment for certain parts of the market could be worse this time than what we even saw during the last downturn, going back to the point of before, that the pandemic is the recession. And until we get that behind us, then people are going to choose to not do certain things that are obviously going to have an impact on different parts of the commercial real estate market. I think things will improve on the other side of a vaccine, but the thing that I've been trying to warn people against, which is to the extent that I understand it, is that it's not going to be like flipping a switch. It's going to take time for people to get vaccinated, for the antibodies to show up, for enough people to get inoculated to some semblance of herd immunity. It's not as if, it's like a sign goes off and it's like, oh, sign's off, now we can go party like it's 1999 or something like that. I think the issue is that it's going to be a gradual thing, even on the other side of a vaccine. And so, to your point, I think there are some people who will feel on an earlier time frame more comfortable doing those sorts of things, and I think there will be other people that on a later time frame are more comfortable doing that. I think I'm a big believer in that it's difficult to change human behavior in the long run, and I'm not an anthropologist. I don't play one on TV. I didn't stay at a Holiday Inn Express last night, but as I sit here and I think about the world, at least as the way that I look at the world, it's really difficult to do that. And I've heard this so many times just in my lifetime, that cities were dead from the 60s to the 70s to the 80s because of all the issues that cities had back then. And then it was after 9/11, nobody's going to travel and nobody's going to live in a city. And then it was after the financial crisis, it's going to totally alter the way that we live our lives, that people are never going to go shopping again, and all these other, these other kind of discretionary pursuits that people have. And now it's with this pandemic, it's going to alter everything. And what you notice is if you look back at those time periods, people's behaviors might adjust at the margin, but the underlying trends are still pretty solid. I mean, before the pandemic hit, we were looking at records for things like air traffic volume and passenger numbers and things like that. So I'm not saying that there won't be some marginal adjustment after this is over. Who knows? Maybe we will still have temperature checks when we go to the airport, which, you know, to be honest, as somebody who in non-pandemic times travels a great deal, I would really like for the person that's sitting down next to me to not be coughing and sneezing while I'm about to get on a, you know, 6-hour transcontinental flight or something like that. But I don't doubt that at some point that there's pent-up demand for a lot of these things, that people will want to take their families on vacations again, and that businesses might be a little bit hesitant at first, but I think over time they're going to realize that there are benefits to actually holding conferences and being around people, both personally and professionally, networking and going to coffee breaks and happy hours and dinners and making connections and learning new things. And I can tell you, as somebody who's been doing this a lot for the last 6 months, it is different. It's not in the sense that I can't convey the message. I think when the world gets back to some semblance of normal, same idea. People are going to appreciate the benefits of being in an office around other people, having important conversations, sharing ideas that something like this doesn't lend itself to. And again, I think at the margin, you will probably see some differences in terms of the way space is laid out and social distancing, and whether or not people have more of an ability to work from home at least part of the time than in the past. I think there's some organizations that probably paid lip service to that instead of being sincere. So again, I don't doubt at the margin that you might see changes, but I think it's always tempting to take a very small data set in a very small time period and extrapolate when that is a significant divergence from the way things had been before. But I think in the long run, you very, very seldom see those kind of significant paradigm shifts in the way that we live our lives, the way we work, the way we live, the way we play. It can happen incrementally over long periods of time, but it's really difficult to point to anything that said, you see that? All of a sudden, everything was different after that. You're like, what was it? Everything different? Or was it marginally different? And that's where I come back to on this. I see marginal differences after things like 9/11 and the financial crisis and the dot-com bubble, probably even this, but it's really hard to see those massive paradigm shifts. I never say never in economics, but I don't have good evidence yet to think that we're going to see this drastically altered world that's wholly unrecognizable what 2019 looked like.
Do you like tequila?
Oh, I love tequila.
Oh my God, I discovered the best, cheapest brand ever. I'm going to mail it to you. All you got to do is get one right, okay?
All right.
All right, tallest building in the world.
Are we measuring it by the structure completely, or does it have to, or is where it terminates on floors?
I don't know. I went off Wikipedia.
What is the name of it now? It's, I'm never going to get it right. It's like the Al-Burj Tower. I can never remember.
Oh my God, that's so close. So I think it's Burj Khalifa is how you pronounce it, but I'm not 100%
what it is.
sure.
Yes.
I'll give you that one. That's close.
We still haven't built one taller than that, although people are sketching it out.
Yeah, it's amazing. It's been the tallest for a long time. But it must be nice to have Dubai money. Of course, as soon as somebody tops it, they'll build something else. Which is cool.
They will.
All right, so any idea on this one? What is the largest REIT by market capitalization?
You know, I should know this, but I don't pay as much attention to the REIT market.
I had to look it up.
Vornado?
That's a good guess. I was really surprised by this. I should ask easier trivia questions. I had never even heard of it. American Tower. They own telecommunication towers.
Yeah,
that wouldn't qualify as a REIT to me. The one I thought of was Prologis, and I think they're doing really well. Industrial stocks are doing well. So
certainly, if you look at
three, but they're number three behind.
Certainly, if you look at the market, I mean, industrial's done really well, so it doesn't surprise me to hear that.
Okay, here's the last one. You already got one, so you're getting your tequila. When was the first house built? First structure we called real estate. Was it 3,000 years ago, 7,500 years ago, or 11,000 years ago?
Wow. I'm going to go 11,000.
That's right. Isn't that crazy? We've been doing real estate for a long time.
My thought on that was that Homo sapiens in the form that we know ourselves today have been around for hundreds of thousands of years. So eventually we'd figure out that we didn't just need caves. I figured it probably took us a couple 100,000 years to be able to figure out how to do that, but it felt more realistic than something too close to where we are today.
Yeah, just figure out some way to stick rocks together. The oldest existing house structure was built in 3,500 BC. So that's still standing. It's not obviously a house anymore. You just have the walls, but it's kind of crazy.
That's impressive. I mean, the fact that somebody could build something like that, and at least part of it is still standing over that period of time, makes you think that the structures we're building today, if we even pay, remotely appropriate attention to maintaining them, probably stand for a really long time.
Okay, last one is I read a part of a book. I'm not ever good at finishing a book, but a guy wrote a book. It was before the last recession called Niagara of Capital. I don't know if you remember that guy, but it didn't get a lot of legs. But the idea was that there's just so much money in the global system that it's just bound and determined to burn out certain sectors. Wherever money finds it wants to go, it goes in. And I feel like right now, looking, if somebody gave you and I, $100 million and said invest it, I think we'd have a really hard time finding any kind of a safe harbor that was priced to even meet inflation, or a value add, or a growth investment that I wouldn't be really worried about. If so, what are your thoughts on that? Where if somebody said, Ryan, I'm giving you $100 million, what are the possibilities?
Normally, my answer to that is I like workforce housing and I like self-storage because, at least in America, we are really good at accumulating stuff and not wanting to get rid of it. There's this psychological effect called the endowment effect, which basically says that we place value on something that's greater to what the cost would be to go out and replicate it in the secondary market. We just like our stuff. And I know in some pockets, even that's been overbuilt a little bit, but in medium to long run, we're really good at accumulating things and not getting rid of them. And I think established properties become very, very bond-like because people don't like getting rid of those things. But I think the broader point is a valid one, that we are operating in a world that has a lot of money that's being generated, but to a large extent, you are dealing with relatively undeveloped or unpalatable, what I'll broadly call asset markets around the world, either actual capital markets, bond markets, fixed income markets, equity markets, or other asset markets, real estate markets, infrastructure markets, because either the governments and the enterprises in those economies haven't built them up, or because investors are somewhat circumspect about operating in some of those markets. And so those economies are still generating a lot of revenue and a lot of money that they need to place somewhere, but often the actual asset base in those markets is not sufficient to actually digest it. So it ends up spilling over into the rest of the world where there actually are developed capital markets, asset markets. This is one of the consequences of those kind of underlying dynamics. You saw it leading up to the financial crisis, and I think we're seeing it again. And I don't have a good solution to that problem other to say that if we had maybe better governance in parts of the world that people had more confidence in, maybe they'd feel more comfortable investing in more economies than just a relatively small number versus the potential number of economies that we could otherwise invest in.
Yeah, I think it becomes a very micro investment world where I can invest in something I know and understand, and I can see and touch in a market that I understand. But I think the global markets, man, I don't envy those people at trading desks right now trying to put money to work. Well, great. We're out of time. Thank you. I appreciate it. And we'll talk.